Welcome once again. This is Pinnacle Professional College, and today we would be discussing or continue our discussion on OECD principles when it comes to corporate governance. We touched on the 6 principles that the OECD looks at, and today we'll be we'll be continuing the last part of it, which talks about the limitations of international codes or statements of principles. What are the limitations? All right. So let's dive into it. Let's dive into it. What are the limitations of international codes or statements of principles? Number one, because they apply to all countries, they can only state general principles. Right? So they are general. These are general principles that are not specific. Also, they cannot give detailed guidelines, and so are not specific. Since they are not specific, they are possibly of limited practical value. So one limitation is that these international codes are more general, they are not specific, and they are not detailed. Number two is that their main objective, as we discussed earlier, is to raise the standard of corporate governance in countries which have not made so much progress when it comes to corporate governance, right? So to countries that have made a lot of progress when it comes to corporate governance, the international codes do not necessarily add much value to them. The international codes only add value to countries who are not well developed when it comes to corporate governance matters. Corporate governance matters. Now, let's talk about financial reporting and corporate governance. Financial reporting and corporate governance. Financial reporting and corporate governance. It's very, very important. So when we talk about financial reporting and corporate governance, one of the key things when it comes to corporate governance are corporate disclosures, communicating on an ongoing basis of what the company is doing and how the company is doing. And one of the key tools when it comes to ensuring accountability when it comes to corporate governance is through financial reports. That's one of the ways to ensure accountability. So a company's annual report, a company's reports and accounts are the main method by which a board of directors communicates with shareholders about the performance and financial position of the company. Right? So this is very important to understand. Every year, there's an annual report, and this annual report has to be audited. The annual report gets audited, and the annual report gets presented to shareholders, and shareholders get to see the performance of the company. So the company's annual report is a form of communication to shareholders about the financial performance as well as the financial position of the company, right? So you have the financial performance and the financial position of the company. This is very, very crucial, very, very crucial. Shareholders rely on the honesty and reliability of financial statements to judge the performance of their investments, right? Shareholders are hoping that these financial statements that are presented to them are actually honest, and reliable. They are, they're actually honest and reliable about the financial statements. Otherwise, it creates a whole problem for them because they do not know how the company is performing and cannot assess correctly the performance of their investments. And this is why, one of the reasons why auditors come into play, because there is senior management, or there's management, there is the auditor, and there is the shareholders. The management is responsible for running the company. The shareholders are the ones who own the company. the management will communicate to shareholders by means of an annual report, right? But if management are the ones who prepare the financial statements, they prepare it, right? If they prepare it, one way to ensure that what they've done is correct is to bring in a third party who will assess what they've done. Otherwise, they can just put anything on the financial statement and give it to shareholders. They can put lies on the financial statements. They can put fake numbers on the financial statements, and there will be no one to tell. Right? There will be no one to tell that these numbers are correct or wrong. So this is where the external auditor comes to play. The external auditor steps in and through several auditing procedures is able to test the validity of the financial statement to a reasonable amount or to a reasonable proportion, right? The auditor does not test every single transaction on the financial statement or every single transaction that occurred in the company. That will be simply impossible. There are billions, for large companies, there are billions and billions of transactions that occur. And so it will be impossible to test every single transaction. But what auditors generally do is they deploy sampling techniques to test samples of transactions, and based on their testing, they are able to do better in terms of assessing on a reasonable level, the validity of the financial statements. Very, very crucial. So a company's annual report is for communication to the shareholders, and shareholders rely on the reports to be honest and reliable. Now, corporate history has shown that there are some concerns when it comes to corporate governance. There are some concerns when it comes to corporate governance. And these concerns are, number one, the risk of misleading financial reporting. Now, we talked about this extensively, where it's possible for executive management to mislead the shareholders with fake or bad financial reports. So that's one concern about corporate governance. Number two is the effectiveness of the statutory external audit. How effective is the statutory external audit? Because if it's not that effective and it's not well done, it can affect the reliability of the financial statements. All right? Can affect them. So these are problems of corporate governance. Number one, misleading financial reports. Number two, effectiveness of the external audits. Number three is the independence of a company's auditors. How independent are the company's auditors? When we say independence, we are talking about the auditors not being influenced by anybody. So the auditors can objectively assess the financial statement. If there's some form of external influence, then it can handicap their proper assessment or their objective assessment of the financial statements. Therefore, recognition of the need for an audit committee resulted from experience with these and other corporate collapses. Requirements relating to audit committees are much stricter in some countries than in others. So because of these concerns, one of the recommendations or one of the things that became highly needed was audit committees. So audit committees are basically committees that exist within the organization that oversee or that basically oversee or have some form of oversight when it comes to the audit process, right? To ensure that the organization has solid controls and a control framework that supports good corporate governance, So the audit committee is internal to the organization and, focuses on all things audit when it comes to the company. So this is where we bring the end of this lecture when it comes to corporate governance. Thank you for listening. If you haven't subscribed to this channel, please do so and have a good day. Bye-bye.